So if I told you that a major consumer company was just bleeding cash on emergency cross-country trucking routes and, getting absolutely hammered by international currency exchange rates.
Oh, yeah.
And on top of that, they're actively admitting on a public call that several of their multi-million-dollar flagship acquisitions are just failing. You'd probably think their stock was in free fall, right? You'd think we were looking at this massive distress signal.
Yeah, you would absolutely assume they were going under.
Right. But today, we are looking at a company that faced all of those exact headwinds, stared them down, and somehow managed to sell $2 billion worth of product in just 90 days.
It is, it's just a phenomenal case study in what happens when sheer consumer demand simply overwhelms macroeconomic gravity. We're looking at an earnings report that, it completely redefines the scale of operations in this sector.
Okay, let's unpack this. Because the company we are dissecting today is Monster Beverage Corporation, ticker symbol MNST. We're looking at their Q1 2026 earnings call transcript, and for the first time in the company's entire history, they smashed through a massive historic ceiling. They crossed the $2 billion revenue threshold in a fiscal first quarter. $2 billion in 3 months.
It's massive.
I really want that number to sink in for you. That is a staggering amount of liquid moving off shelves, out of coolers, and into the hands of consumers. Especially, when you consider the sheer weight and the logistics of moving that much product around the globe.
Right. Well, what's fascinating here is the resilience of that demand. In a retail environment where we are constantly hearing about consumer fatigue, inflation pressure, people trading down to generic brands, Monster is exhibiting this level of pricing power and volume growth that you typically only see in tech monopolies, not consumer packaged goods.
Yeah, and that is exactly why we're doing this deep dive. For you, the retail investor listening right now, you really need to understand the mechanics beneath these massive numbers. So our mission today is simple. We are going to be data forward, look at the actual numbers, translate all this dense Wall Street jargon into plain language, figure out what management is actually signaling, and take a hard stance on whether this is a genuinely bullish scenario for your portfolio. Or, if there are cracks in the foundation.
Because there is always a cost.
Exactly. Because when you see a top-line net sales number of $2.35 billion, which, by the way, is a 26.9% increase from the $1.85 billion in Q1 of 2025, your immediate instinct is just to celebrate. But we need to know what it cost them to get there.
We do. And before we get to those costs, I think we need to understand the composition of that revenue. The symmetry between their top line and bottom line is really where this story begins. You mentioned the $2.35 billion in net sales. But if you look at earnings per share, or EPS.
Which is essentially the total profit divided by the number of outstanding shares, right?
Right. Yeah. It represents your specific slice of the pie as an investor. So diluted EPS increased 27.6% to 58 cents.
Wait, so revenue is up roughly 27% and profit per share is up roughly 27%?
Exactly that symmetry. And operating income also increased 28.1% to $730 million. So this tells us something super crucial. This growth isn't a parlor trick.
What do you mean by a parlor trick?
Well, sometimes a company will boost their top-line revenue by just slashing prices, right? Running massive discounts or basically giving the product away just to show Wall Street that they have market share growth.
Oh, I see. So they sell more, but they make way less money on each sale.
Exactly. But when operating income and EPS rise in lockstep with revenue like this, it means they are maintaining their fundamental unit economics. They are selling more cans, and they are making the exact same or even better profit on every single can.
I see where you're going. However, when I dig into the transcript, I realize they aren't just selling the original green cans anymore. They report this massive revenue in very specific segments, and I've got to be honest, some of them are incredibly bizarre.
They are definitely highly diversified.
Yeah, let's start with the normal stuff first, though. The absolute juggernaut is, as expected, the Monster energy drink segment. That alone brought in $2.19 billion the total, up 27.6%. Then you have the strategic brand segment, which brought in $126.7 million, up 28.9%.
And that strategic brand segment, that's largely comprised of the various acquisitions and secondary energy labels they've absorbed over the years, to capture different niche demographics.
Right. But then we hit the alcohol brand segment, which is the one traditional division that actually contracted. It brought in $32.7 million, which is down 5.9% compared to the 2025 first quarter. Now, management said excluding the alcohol segment is purely illustrative, But clearly, the explosive growth isn't coming from the hard seltzer or craft beer side of their portfolio right now.
No, definitely not.
But here's where it gets really interesting, and frankly, a bit confusing for me. When you look at the raw factual data reported in this transcript, there are some internal reporting divisions that sound like they belong in a completely different universe.
Oh, yeah. You're referring to the legacy reporting anomaly.
Anomalies is putting it mildly. I mean, according to the data presented, they have a blushy division in loungewear segment, which actually increased 3.2% to $19.8 million. They have a division reporting on robot pounds, which decreased 1.94% to 40.4.
Right.
They cite the Toronto market increasing 6.9% by breaking $26 morning economics to $18 nom. And my personal favorite, a 1999 joint firm listed as Intend.Tayax Iberpunkiendas, where something called Clutchplug.com was up 100%, while overall company figures in that venture were down 74%. I mean, what on earth are we looking at here? Are they selling sweatpants and cybernetics alongside energy drinks?
It sounds totally absurd, I know. But this actually raises a really important question about how corporate accounting works at this massive scale. When you read a 10Q or an earnings transcript for a multinational conglomerate that has been operating and acquiring entities for literally decades, you are often looking at an archaeological dig of corporate structuring.
So you're saying these aren't core strategic initiatives for 2026?
No, far from it. When a company acquires a brand, sometimes they absorb strange legacy subsidiaries or like joint ventures formed during the dot-com bubble in 1999.
Touchplug.com.
Exactly. Or hyper-specific regional distribution agreements, like whatever unique pricing matrix constitutes Toronto morning economics. For legal, tax, or just weird contractual reasons, these entities cannot always be immediately dissolved or neatly folded into the main energy drink line item. So by law, they have to report the material data on these segments, no matter how eccentric the naming conventions are from decades past.
I mean, that makes sense from a compliance standpoint. But as a retail investor trying to decide whether to buy the stock, it feels like incredibly distracting noise. I mean, clutchplug.com being up 100% means absolutely nothing to me if I'm trying to evaluate their beverage market share.
And it really shouldn't mean anything to you. The actionable insight here is just about scale and proportion. Think about it. That loungewear division brought in $19.8 million. The core energy segment brought in $2.19 billion. The energy segment is literally 100 times larger. As an investor, you cannot afford to lose the forest for the loungewear. These bizarre line items are just microscopic rounding errors on a balance sheet dominated by a global beverage juggernaut.
Fair enough. I will ignore the robot pounds and focus on the green cans. But that brings us to a very real factor that does impact those billions of dollars, and it was a massive point of contention on the call.
Currencies.
Yes, the FX impact. There was a lot of back and forth about foreign currency exchange rates. Management mentioned a favorable impact of $89.3 million, but then they kept leaning heavily on a metric called foreign currency adjusted basis. They claimed net sales increased 22.1% under that specific lens. Let's translate this. Why does an investor in Ohio care about currency fluctuations in Europe?
Well, they care because foreign exchange, or FX, is arguably the most vital lens for judging the true ground-level health of a global company. Let's break down the mechanics. Monster sells a tremendous amount of product outside the United States. Let's take Europe as an example. When a consumer buys a Monster in Berlin, they pay in euros. That money goes into Monster's European accounts in euros.
Right. But Monster is headquartered in California, and they have to report their quarterly earnings to Wall Street in US dollars.
Precisely. That's the tension point. They have to convert those euros back into dollars to put them on the spreadsheet. Now, let's imagine a scenario where Monster's operations in Germany are perfectly flat. They sell the exact same number of cans for the exact same price in Q1 of 2026 as they did in Q1 of 2025. Operationally, nothing changed at all.
Okay, so the business is completely stable.
On the ground, yes. But let's say over that same 12-month period, the macroeconomic environment shifts and the US dollar becomes significantly stronger relative to the euro. When Monster takes that identical pile of euros from Germany and converts them back into US dollars at the end of the quarter, they just get fewer dollars back.
Ah, I see. So when they publish their earnings report, it looks like their German sales actually dropped.
Yes, exactly. The spreadsheet will show a decline in revenue. And if you are an uneducated investor, you might panic and sell the stock thinking, oh no, Monster is losing market share in Germany. But they aren't losing market share. They didn't lose a single customer. They just got caught in the invisible undertow of global currency markets. which is something the CEO has absolutely zero control over.
So when management points to the foreign currency adjusted basis number, they are basically creating this alternate reality where exchange rates never move.
I wouldn't call it an alternate reality. It's a normalization technique. They are saying to investors, look, strip away the macroeconomic noise, ignore the Federal Reserve and the European Central Bank for a second. If exchange rates had remained perfectly frozen from a year ago, this is how much our revenue would have grown based purely on our ability to sell more liquid in aluminum cans.
Okay, but hold on. I get why management wants us to look at the FX neutral number because, it makes them look better. But at the end of the day, they still have to pay dividends and buy back shares with actual US dollars, right? If the strong dollar is constantly eating their lunch, isn't that a permanent impairment to the stock's value, regardless of how many cans they move?
That is a highly astute challenge. And you're right, it's true. You cannot pay your American employees with a currency-adjusted fantasy dollar. However, currency cycles fluctuate over time. The dollar strengthens, the dollar weakens. What management is trying to communicate is that their operational foundation, so their market share, their shelf space, their consumer loyalty, is expanding rapidly. If you build massive market share while the dollar is strong, you might take a short-term hit on the conversion. But when the currency cycle eventually turns and the dollar weakens, all of that massive international volume acts like a coiled spring, and your reported US dollar revenue will absolutely explode.
That makes total sense. So the takeaway for the retail investor is that a 22.1% increase on an FX-adjusted basis proves their operational engine is roaring, completely independent of whatever the central banks are doing.
Exactly.
But let's pivot to what it actually costs to run that engine. Because we know the top line is huge, but as the saying goes, revenue is vanity and margin is sanity. Let's look at their international footprint, which is expanding aggressively.
Yeah.
Sales to customers outside the United States increased 44.9% to $1.06 billion. International sales now make up roughly 45% of total net sales.
And the standout star in that international portfolio is EM. So that's Europe, the Middle East, and Africa. Net sales in EMEA increased by an astonishing 52.5% in actual dollars. But this incredible geographic expansion comes with a hidden cost, and it's a cost that directly impacts their gross margin.
Yeah, the transcript explicitly noted that this geographic mix had an adverse impact of 120 basis points on gross margin. For our listeners, a basis point is 1/100th of a percent. So 120 basis points means their overall company gross margin dropped by 1.2% simply because of where they were selling the product. Why does selling in Europe or Africa hurt their profit percentage compared to selling in, like, Texas?
Well, I mean, it really comes down to the unit economics of emerging versus mature markets. In the United States, Monster has a fully optimized, incredibly mature distribution network. They can charge a premium price at a convenience store because the American consumer can bear that cost. So the margin profile on a can sold in Los Angeles is very high. But when you move aggressively into Africa or certain parts of Eastern Europe, you're dealing with entirely different consumer purchasing power, different distribution logistics, and different tax regimes. To gain market share in those regions, you often have to price the product lower, or you have to absorb higher logistical costs just to get the product onto a rural shelf.
Right. So the profit margin on a can sold in Kenya is fundamentally lower than a can sold in California.
Correct. And this leads to what we call the margin paradox. Let's look at a direct quote from Vice Chairman and co-CEO Hilton Schlossberg during the Q&A session. An analyst pressed him hard on this 120 basis point drop in margin. The analyst really wanted to know why margins were shrinking, and Schlossberg bluntly replied, "You don't bank percentages, you bank actual dollars."
That is such a fantastic, aggressive corporate quote. But break down the math for me. How can a shrinking profit margin be a good thing?
Let's use a very grounded analogy. Imagine you own a local independent pizza shop. On a normal Tuesday night, you sell 100 pizzas. Your cost of ingredients is low, your staff is totally optimized, and you make a 50% profit margin on those pizzas. It's a highly profitable, quiet night.
That's like great business.
It is. But suddenly, a massive corporate event next door realizes their catering fell through, and they call you up in an absolute panic. They order 500 pizzas, and they need them in 2 hours. You don't have enough wholesale dough in the back room to fulfill the order. So you have to send your delivery driver across town to the local supermarket to buy retail-priced dough and cheese just to get the job done. And you have to pay your staff overtime.
Oh, wow. So the cost of goods sold just skyrocketed for those extra pizzas.
Drastically. Because you paid retail prices for the emergency ingredients, your profit margin on those 500 pizzas drops from your normal 50% down to maybe 20%. If an analyst only looked at your margin percentage for the night, they would say, wow, your business is failing. Your margins collapse from 50 to 20%.
But at the end of the night, the owner is walking to the bank with a bag of cash that is 5 times heavier than a normal Tuesday. He made a smaller percentage, but on a massive new volume of sales.
Exactly. He doesn't care about the percentage. He banked massive actual dollars. That is the exact dynamic Monster is experiencing with their international expansion. By pushing heavily into EMEA, their global average profit margin percentage is being dragged down. On a spreadsheet, the margin is shrinking, but they are bringing hundreds of millions of new absolute dollars into the company that they would not have had otherwise. You can't take a percentage to the bank to make payroll or fund a share buyback. You can only take dollars.
I love that framing. But let's stay on the pizza analogy for a second, because the emergency trip to the supermarket to buy dough perfectly maps onto the next major cost headwind they faced in Q1. Management referred to it as out-of-orbit production. When I first read that, I genuinely thought they were launching cans into space. What is the orbit of a beverage company, and why did they break out of it?
If we connect this to the bigger picture of supply chain logistics, the orbit is the geographic radius around a bottling or co-packing facility. Remember, an energy drink is mostly water, and water is incredibly heavy. Shipping heavy liquids over long distances in diesel trucks is financially ruinous.
Right, so you want the heavy liquid produced as close to the thirsty consumer as humanly possible.
Yes, that is the holy grail of beverage logistics. Monster doesn't own all their own manufacturing plants. They use a highly optimized network of co-packers. They assign specific retail territories to specific plants. For example, a plant in Ohio might handle all the demand for the Midwest. That is its orbit. But in Q1, consumer demand absolutely exploded beyond management's wildest forecasts.
So the local Ohio plant just ran out of capacity. Why not just tell them to run the machines faster?
Because co-packers don't just make Monster. They might be contracted to make Diet Coke on Tuesday, Sprite on Wednesday, and Monster on Thursday. Their line time is fiercely allocated. If Monster suddenly needs double the product in Ohio, the Ohio bottler might say, sorry, we're fully booked. So what does Monster do? They look at their national map, they see that they have open line capacity at their facilities in Norwalk, California, or Phoenix, Arizona.
Oh, wow. So they have to manufacture the product in the desert in Arizona and then put that heavy liquid on an 18-wheeler and drive it all the way to Ohio just to meet the demand.
Yes, that is out-of-orbit production. They're paying a massive premium in diesel fuel, trucking logistics, and transit time to get the product to where it needs to be.
But wait, if they are losing that much money on freight, why not just let the Ohio shelves sit empty for a week until the local bottler can catch up? Surely taking a 1-week pause is better than destroying your unit economics by shipping water across the Rocky Mountains.
That is the temptation of short-term thinking, but it's a fatal mistake in the beverage industry. In consumer packaged goods, shelf space is warfare. If a loyal Monster consumer walks into a gas station in Ohio and the Monster shelf is empty, they aren't going to just drink tap water.
They just reach 1 inch to the right and buy a Celsius.
Exactly. They reach for a Celsius or a Red Bull or a Ghost energy drink.
And once they try the competitor, you risk losing them forever.
Precisely. You lose the lifetime value of that customer over a temporary supply chain hiccup. So management made the strategic decision to eat the massive freight costs, fire up the out-of-orbit production in Phoenix, and ensure that those retail shelves remained stocked at all costs. It hurt their gross margin in Q1, but it protected their long-term market share. As an investor, you want a management team that is willing to take a short-term logistical hit to defend the moat around their brand.
Okay, so the out-of-orbit production is a symptom of incredibly high demand, which is fundamentally a good problem to have, even if it's expensive to solve. But there was another cost headwind that isn't about demand at all. It's just raw commodity inflation. They mentioned aluminum tariffs, specifically something called the Midwest Premium, causing a gross margin headwind of just under 1%. What exactly is the Midwest Premium?
This is one of those arcane supply chain mechanics that rarely gets explained to retail investors. So aluminum is a globally traded commodity. You can look up the spot price of aluminum on the London Metal Exchange. But that global benchmark price just gives you the right to own the metal in theory. It doesn't actually get the physical metal into your factory.
Right. You can't build a can out of a futures contract. You need the actual metal.
And that is exactly where the Midwest Premium comes in. It is the logistical surcharge. It's the cost of physically storing, insuring, loading, and transporting the massive aluminum ingots from warehouses in the U.S. Midwest to the actual manufacturing facilities. Because of geopolitical tariffs, fluctuating fuel costs, and warehouse bottlenecks, this premium can swing wildly, entirely divorced from the global price of the metal itself.
So even if the global price of aluminum goes down, the cost to physically move it across America can go up, hitting Monster's margins.
Yes. Management noted this under 1% headwind and warned it will likely continue sequentially through the end of 2026. However, notice their tone on the call. They called it modest. They aren't panicking. They hedge these costs where they can using financial instruments, but ultimately they are relying on sheer volume growth to outrun the commodity inflation.
Okay, so we've established that they are moving massive volume, and we know exactly why it's costing them a bit more in freight and aluminum to do it. But let's zoom in on the actual product. What exactly is inside these cans that is driving people to buy them at historic rates? Let's talk about the balance between their core lineup and their innovation pipeline.
This is really a masterclass in portfolio management. In the consumer packaged goods space, there is a constant, dangerous tension between legacy core products and shiny new innovations. If you don't innovate, your brand gets stale and consumers get bored.
But if you innovate too much, you cannibalize your own sales. You don't want a loyal customer swapping their daily original green Monster for a new flavor. You want them buying both, or you want to acquire a totally new customer.
Exactly, and the data from this quarter proves they are threading that needle perfectly. Management explicitly stated that 55% of their growth is coming from existing SKUs, so the core is rock solid. In the U.S., the Ultra brand family, that's the zero sugar line in the textured cans, grew 20%. And the undisputed heavyweight champion of that line, Ultra White, grew a staggering 34%.
Oh man, Ultra White is everywhere. It's the white can with the silver claw marks. You cannot walk into a gym, an office, or a college campus without seeing it. And the transcript noted that in the EVA region, Ultra White was up over 50%. It's a global juggernaut. But here's the data point that actually shocked me. Full sugar.
Yeah, that was surprising.
Right. For the last 5 years, every trend piece has declared the death of sugar. Wellness influencers say everyone is pivoting to zero-calorie clean energy.
Yeah.
Yet, Monster's full sugar portfolio, the original heavy green cans, grew 8.5% in the quarter. How is that possible?
Well, because the media narrative about wellness doesn't always reflect the reality of the blue-collar workforce or the core energy demographic. The full sugar offerings represented approximately 1/3 of their total U.S. gains. That tells us that the original consumer base, so the construction workers, the long-haul truckers, the extreme sports fans who built this brand in the 2000s, they are fiercely loyal. They aren't abandoning the brand for a zero-calorie alternative.
So the core is definitely safe, but they aren't resting on their laurels either. They have a massive pipeline driving the other 45% of their growth. Let's look at the innovations. They launched Storm, which is a wellness brand with 4 SKUs. They introduced Flirt in late March to specifically target female entry into the category. They rolled out the Lando Norris Zero Sugar globally. They launched Viking Berry in Europe, which they claimed was their most successful launch ever in EMEA.
What's fascinating here is the surgical precision of these launches. They aren't just throwing random fruit flavors at a wall to see what sticks. Take Flirt, for example. Historically, the energy drink category has skewed heavily male. The marketing was aggressive, dark, and hypermasculine. By launching a brand positioned specifically for female consumers, they aren't just trying to steal a customer from Red Bull. They are trying to expand the total addressable market. They are trying to convince a woman who currently drinks iced coffee to switch to an energy drink.
That brings up a massive point about their marketing strategy. You look at their sponsorships, and it is a relentless barrage of high adrenaline, culturally dominant sports. They mention their new UFC broadcast partner, claiming it yielded a 3x increase in television viewers staring directly at the Monster logo in the center of the octagon. They're dominating MotoGP with Marco Bezzecchi. They sponsor the McLaren Formula One team with Lando Norris and Oscar Piastri. They took home 27 medals at the X Games.
It is an absolute omnipresent strategy.
It is. But I really want to push back on this. Sponsoring Formula One and UFC costs tens of millions of dollars. Does slapping a green claw on a race car actually translate to a teenager buying a can at a 7-Eleven? How does this justify the massive expense?
To understand that, you have to look at the math of customer acquisition cost, or CAC, versus lifetime value, or LTV. If Monster buys a traditional 30-second commercial on primetime television, they are paying a massive premium for a very brief, interruptive impression that most viewers will just ignore or fast forward through.
Right. Traditional advertising is notoriously inefficient.
But look at the UFC Octagon sponsorship. When you put your logo dead center on the canvas of a UFC fight, that logo is on screen continuously for 15 to 25 minutes during a main event. The viewer cannot skip it. It becomes native content seamlessly integrated into a moment of high emotional intensity. So the cost per minute of exposure plummets compared to a traditional commercial. This drives down their blended customer acquisition cost.
And it reinforces the premium nature of the brand. If you see it next to world champions, you subconsciously accept that it's a premium product. Which leads perfectly into my next question about the consumer's wallet. We keep hearing about macroeconomic inflation. Rent is up, groceries are up. Are people really just sucking up price increases on energy drinks because they saw it on a UFC broadcast?
The data gives us a very clear empirical yes. Rob Gehring, the CEO of the Americas, addressed this directly on the call. He noted that the modest pricing actions they implemented in late 2025 are performing exactly as expected. The volume didn't drop when the price went up. The category is showing immense resiliency.
He used a phrase I found really interesting, affordable luxury. He basically argued that while a consumer might be priced out of buying a new car or taking a vacation, they can definitely still scrounge up $3 to buy a momentary mental escape and a burst of energy.
That psychological dynamic gives Monster incredible pricing power. But they're also deploying a very sophisticated packaging strategy to lock in that volume. It's not just about raising the price of a single can at the gas station. It's about shifting the foundational consumer behavior through multi-packs.
Yes. The transcript spent a lot of time on this. They talked about a massive shift toward 12 packs and 24 packs, specifically in the club channel. Places like Costco and Sam's Club. Why is this such a big deal?
Because it fundamentally changes the relationship between the consumer and the product. Historically, energy drinks were almost exclusively impulse buys. You are on a road trip, you start for gas, you feel tired, you grab a cold can from the cooler. The purchase is dictated by a momentary physical need.
But if I buy a 24-pack at Costco?
Exactly. If you buy a 24-pack and put it in your garage refrigerator, the dynamic shifts. The product transitions from an unpredictable impulse purchase into a planned daily household staple. It's pantry loading.
Because if it's sitting in the fridge, I'm going to drink it. Even if I'm not that tired, I'll grab one before I mow the lawn just because it's there.
Precisely. It dramatically increases the buy rate, which is the frequency of consumption per household. Furthermore, once that 24-pack is in your fridge, you are blind to the competition. You aren't standing in front of a convenience store cooler comparing the Monster can to the Red Bull can. You are locked in. It secures long-term loyalty and guarantees massive volume.
Okay, so that perfectly encapsulates the operational triumphs of Q1. But as a retail investor, you don't buy a stock for what happened yesterday. You buy it for what happens tomorrow. We need to look out the windshield. Let's dig into management guidance and what they see coming down the pike. They actually gave us a sneak peek at April 2026.
And those preliminary numbers were red hot. They estimated that April 2026 sales on a non-FX adjusted basis were up 24.4% compared to April 2025. And if you exclude the dragging alcohol segment, the core business was up 24.9%.
So the Q1 momentum is barreling right into Q2. But Hilton Schlossberg immediately threw a bucket of cold water on those numbers. He spent a solid 2 minutes telling analysts not to get overly excited about a single month of data. Why would a CEO downplay a 25% growth metric?
It's classic expectation management. He cautioned that a short period, like a single month, can be disproportionately warped by logistical quirks. For instance, the timing of Easter, the number of actual selling days in the month, or even just a major distributor deciding to load up on inventory a week earlier than usual. If an analyst extrapolates a weird April spike across the entire second quarter, they will build an impossibly high financial model. When Monster inevitably misses that inflated target in Q2, the stock will tank. Schlossberg is grounding the analyst to protect the stock stability.
Under-promise and over-deliver. I get it. But it wasn't all just cautious optimism in the guidance. They were surprisingly blunt about some of their failures. Schlossberg literally stated on the call that strategic brands like Bang, NS, and Full Throttle have a lot of work to do. I found that transparency shocking. Usually, corporate earnings calls are just exercises in aggressive spin. For a co-CEO to look at a multi-million-dollar acquisition like Bang and publicly admit that it's floundering takes a lot of nerve.
It does, but it also signals accountability. Let's look at the context of Bang. Monster acquired Bang after a long, viciously litigious history between the two companies. During that legal warfare and bankruptcy process, the Bang brand lost its distribution footing and a lot of its cultural cachet. It requires a massive rehabilitation project.
Right, they can't just flip a switch and make it popular again.
Exactly. And as for NS and Full Throttle, those are legacy brands tied heavily to early 2000s automotive culture. The demographics have shifted. Those brands require fundamental modernization to resonate with a new generation of consumers. By admitting the problem, management is establishing a baseline so that when the turnaround strategy finally takes effect, they can point to the growth.
Speaking of brand architecture, they also mentioned repositioning Storm. We touched on the launch of Storm earlier, but they explicitly noted they are trying to move Storm firmly into the wellness category to clearly separate it from Rainstorm, which they are positioning strictly for performance. Why does this semantic difference matter so much?
Because consumer confusion is the absolute enemy of conversion at the retail cooler. If a consumer has 10 seconds to make a choice, they need to instantly understand the value proposition of the liquid in the can. Performance implies a pre-workout scenario: high caffeine, beta-alanine, sweat, aggression. Wellness implies daily hydration, vitamins, mental focus, recovery.
So if a consumer wants a midday focused drink at the office, but they accidentally buy the performance drink and their heart starts racing, they're going to hate the brand.
Exactly. By clearly bifurcating Storm and Rainstorm into distinct categories with distinct packaging cues, they avoid alienating the consumer and they prevent the two brands from cannibalizing each other's sales.
That is a subtle but critical strategy. Now, let's look at the global runway, because the expansion guidance was massive. They announced that Monster Energy Green is going into Coca-Cola Japan vending machines this summer.
Do not underestimate the geopolitical and financial power of the Japanese vending machine network. It is arguably the most dense, high-volume, hyper-efficient retail environment on the planet.
Wait, really? More than American convenience stores?
Absolutely. In cities like Tokyo, real estate is so premium that vending machines act as micro-convenience stores on almost every single block. Coca-Cola dominates that infrastructure. Securing prime placement for Monster inside the Coca-Cola system in Japan is a massive catalyst. It displaces legacy tea and coffee products and puts Monster directly into the daily commute of millions of consumers in the APAC region.
And speaking of massive populations, the growth numbers out of emerging markets were staggering. India sales were up 94.5%, China was up 95% in dollars, and the transcript noted they are achieving this hypergrowth primarily through their affordable brands, Predator and Fury, which are also dominating the African continent.
Right. And this raises an important question for the retail investor regarding the terminal value of the company. Just how much further can this international runway go? When you look at the combined populations of India, China, and the African continent, the total addressable market is exponentially larger than North America.
But they don't have the same purchasing power. They can't afford a premium-priced Monster can.
Which is precisely why deploying Predator and Fury at an affordable price point is a brilliant long-term play. They are establishing brand dominance and distribution networks early. They are creating a generational pipeline of consumers. As those developing economies mature and individual purchasing power increases over the next decade, those consumers can eventually be traded up from the affordable tier into the premium core Monster portfolio. They were planting seeds for harvest in 2035.
It's an incredible long game. Now, I want to talk about something that gets every Wall Street analyst hot and bothered.
Right.
Share repurchases. During Q1, Monster bought back 1.4 million shares of its own stock at an average price of $73.86, totaling about $100 million. And management noted they still have $400 million remaining in their authorized buyback program. Conventional wisdom says buybacks are bullish, but I want to test that theory.
Go ahead.
So I'm looking at the authorization. They have a $400 million war chest left to deploy. They only spent $100 million this quarter. If management truly believes the stock is trading at a massive discount, why not back up the truck and deploy the whole $400 million right now? Are they holding cash back because they're secretly worried about those international margin compressions and out-of-orbit freight costs we talked about?
That is a highly sophisticated reading of the balance sheet, and you're touching on the fundamental tension of corporate capital allocation. A share buyback is generally a vote of confidence. When a company buys its own stock at $73, they are telling the market they foresee future cash flows that justify a much higher valuation. However, to answer your challenge regarding the reserved $400 million, responsible management does not drain their liquidity to zero no matter how cheap the stock looks.
Because they need a buffer for unexpected shocks.
Partially that. But more specifically in this case, they need cash on hand for a massive internal project they disclosed in the guidance. They mentioned an SAP S/4HANA upgrade going live on January 1st, 2028. In this quarter alone, they recorded $5.8 million in expenses related to digital transformation initiatives.
Okay, for the non-technical investor, SAP sounds like boring IT software. Why is a beverage company spending millions of dollars on software, and why do they need a massive cash buffer for it?
SAP is the enterprise resource planning software that runs the entire nervous system of the company. It handles the supply chain logistics, the co-packer allocations, the financial reporting, the HR, everything. Upgrading to the S/4HANA cloud environment is not just downloading an update.
Let me guess. It's an absolute nightmare.
It's like trying to replace the concrete foundation of your house while you are simultaneously throwing a massive house party upstairs. You are going to see some cracks in the drywall, it's going to disrupt the guests, and it's going to cost an absolute fortune in contractor fees.
But if you don't replace the foundation, the house eventually collapses under its own weight.
Exactly. Operating at a multi-billion-dollar global scale on legacy on-premise servers is a massive operational risk. This IT upgrade will cause persistent, multi-million-dollar cost drags every single quarter between now and 2028. That is why they aren't blowing their entire $400 million buyback authorization all at once. They are meticulously managing their cash flow to fund the digital transformation while slowly retiring shares.
Okay, we have covered a phenomenal amount of ground today. We've dug into the mechanisms of foreign exchange, the logistics of cross-country beverage trucking, the psychology of club channel multi-packs, and the pain of enterprise software upgrades. It is time to bring all of this data together into a concrete thesis. Let's look at the bottom line and distill the actionable insights for the retail investor. If someone is holding MNST stock or considering opening a position, what is the ultimate verdict? Let's start with the bearish or cautionary case based strictly on this transcript. Where are the cracks?
Well, the most glaring negative data point geographically was Argentina, which saw a 53.5% drop in net sales. Now, management attributed this to a lower price per case, driven by a change in their business model late last year to better manage foreign currency exposure, but it highlights a real risk. Operating in hyperinflationary emerging markets can destroy your revenue on paper, even if consumer demand remains high.
Right. You can sell 1 million cans, but if the local currency collapses, those cans are essentially worthless when converted back to dollars. What else?
The continuous cost headwinds. The aluminum tariffs and the Midwest premium are sticky. They aren't going away anytime soon. The out-of-orbit production shows that their supply chain is stretched to its absolute limit, requiring expensive logistical band-aids. The alcohol segment is shrinking. They openly admit that major acquisitions like Bang require significant time and capital to rehabilitate. And as we just discussed, the digital transformation IT project is going to siphon millions of dollars every quarter for the next 2 years.
That is a solid bear case. It's not apocalyptic, but it's a sobering reality check on their margins. However, when we weigh that against the bullish case, the overarching signal of this quarter seems undeniably powerful.
It really is. The bullish case is predicated on sheer, unstoppable volume. Monster is expanding globally at double-digit rates across almost every single territory, completely shrugging off the strong US dollar on an operational level. They're actively taking market share away from their fiercest competitors. They noted they are now the #1 energy drink in Australia and Denmark by value, directly dethroning Red Bull.
And they're doing all of this while successfully pushing through price increases without destroying consumer demand. The pricing power is fiercely intact. The core product, specifically Ultra White, is an absolute juggernaut that seems immune to consumer fatigue.
So when we synthesize this for the retail investor, what it means is that you are looking at a management team that is proving it can navigate macroeconomic turbulence. They have the logistical leverage of Coca-Cola's massive global bottling network to push into heavily guarded markets like Japanese vending machines. But more fundamentally, if we connect all these data points, we are witnessing a massive paradigm shift in what this company actually is.
A paradigm shift. How so?
For the last 20 years, Monster was viewed by Wall Street as a niche, extreme sports beverage. It was the rebellious brand for motocross riders and teenagers staying up late playing video games. But the data from this quarter tells a completely different story. The success of the wellness brand Storm, the targeted demographic acquisition with Flirt, and most importantly, the massive structural shift toward 24 packs in warehouse club channels indicates that Monster is actively shedding that niche image.
It's transitioning into a staple consumer packaged good. It's becoming the boring, reliable thing that families buy in bulk at Costco to stock the garage fridge right next to the paper towels and the bottled water.
Exactly. And when a brand makes the leap from an impulse novelty to a household staple, its valuation multiple and its revenue floor fundamentally change for the better.
That is a profound shift in consumer behavior. And that brings us to the end of our deep dive today. We have thoroughly unpacked a historic quarter for Monster Beverage Corp. A record-breaking $2.35 billion in Q1 revenue, 27.6% EPS growth, global expansion firing on all cylinders, and a management team executing a masterclass in operational scale. They proved that even with out-of-orbit supply chain chaos, sticky commodity inflation, and currency headwinds, relentless consumer demand can conquer almost anything.
It's a true testament to the power of building an unassailable brand moat.
We want to thank you, the listener, for joining us today. Our goal is always to cut through the Wall Street noise, translate the corporate jargon, and get straight to the facts and the mechanics that actually matter to your portfolio. But before we sign off, we want to leave you with one final provocative thought to mull over.
If we truly accept this paradigm shift we just discussed, the launch of Flirt to capture new female demographics, Storm for general midday wellness, and this aggressive, successful shift into bulk club channel pantry loading, it means energy drinks are fundamentally shedding their old rebellious teenager image. They are becoming entirely normalized across all demographics. So ask yourself this: if the energy drink category continues on this trajectory and achieves the exact same total household penetration as traditional sodas did in the 1990s or as daily coffee did in the 2000s, what does that mean for the ceiling of this entire industry over the next decade? Are we currently looking at the slow, inevitable end of traditional soda as the default American beverage?
That is a massive, multi-billion-dollar question to ponder next time you open the fridge and reach for a can. Thanks for joining us on this deep dive. Keep your eyes on the data, and we'll see you next time.